Welcome back to the Daily Crypto Deep Dive. Today, we're not looking at price action. We're looking at power. The kind of power that shapes empires, crashes markets, and quietly decides which currencies live or die. Because for years, the Federal Reserve has been trying to prove one thing, that it can control inflation, liquidity, and the global cost of money. But in doing so, it might have done the exact opposite of what it intended. It didn't crush risk. It didn't end speculation. It created the perfect conditions for Bitcoin to thrive. This is the story of how the Fed, the most powerful central bank on Earth, accidentally supercharged the very asset that was designed to replace it. It began with fear. In 2020, the world stopped. Supply chains broke. Governments panicked. The Fed printed trillions to keep the system alive. In just 12 months, America's M2 money supply ballooned by more than 40%, the fastest expansion in U.S. history. For perspective, that's more monetary creation in a single year than in the previous 2 decades combined. For a while it worked. The market soared. Stocks hit record highs. Bitcoin exploded from under 10,000 to over 60,000 in barely a year. The narrative was simple. Liquidity was infinite. Risk was free. But underneath, the seeds of inflation were already taking root. By 2022, the storm arrived. Inflation hit 9.1%, the highest since the early 80s. Gas, food, rent, everything spiked. The Fed reacted with panic of its own, hiking interest rates faster than at any point in half a century, from near zero to over 5% in less than 18 months. That should have killed Bitcoin. Every textbook said so. Tight money drains risk. Liquidity dies, leverage unwinds, and speculative assets collapse. For a while, that's exactly what happened. Bitcoin fell more than 75% from its highs. Headlines declared the end of crypto. The Fed had restored order. Or so it thought. But the Fed misunderstood what Bitcoin actually is. Because while higher rates make dollars more expensive, they also make faith more fragile. Every rate hike amplified the cracks in the system. Bonds collapsed in value. Banks that once held risk-free treasuries started bleeding capital. Silicon Valley Bank failed first, then Signature, then Credit Suisse. In just 3 months, the global financial system lost more than $600 billion in unrealized bond losses. And through it all, one asset quietly began to rise from the ashes: Bitcoin. In the week that Silicon Valley Bank failed, Bitcoin surged 30%. When the Fed announced its 9th consecutive rate hike, Bitcoin rose again. Analysts started asking the question no one expected. Had Bitcoin become a safe haven? What the Fed didn't see was that by weaponizing interest rates, it was pushing capital toward assets without counterparty risk. Bonds could default, banks could fail, but Bitcoin, with its algorithmic issuance and transparent supply, looked immune. Glassnode data from that quarter showed record wallet growth among both retail and institutional holders. Self-custody withdrawals from exchanges hit an all-time high. It wasn't speculation anymore. It was survival instinct. The irony is almost poetic. The Fed's mission was to defend the dollar. Instead, it reminded the world why Bitcoin was invented. When the Fed prints, Bitcoin rises. When the Fed tightens, Bitcoin's narrative gets stronger. Either way, Bitcoin wins. Money works on 2 foundations: trust and scarcity. Fiat money relies on trust. You believe the government won't destroy its value. Bitcoin relies on scarcity. You know mathematically that it can't. When inflation skyrocketed, the world questioned trust. When rates rose and banks cracked, the world rediscovered scarcity. By trying to contain one crisis, the Fed simply accelerated the next. And the data proves it. According to Fidelity's Digital Assets Division, institutional allocation to Bitcoin-based products rose 160% from mid-2023 to late 2024, directly overlapping the Fed's most aggressive tightening cycle. CoinShares inflow data confirmed it. During weeks of market stress, Bitcoin funds outperformed equities and gold ETFs by wide margins. It turns out the ultimate advertisement for Bitcoin isn't a Super Bowl commercial. It's central banks losing control. Analysts at Bloomberg Intelligence now describe Bitcoin as a high-volatility inflation hedge. That sounds contradictory, but it fits the new reality. The same tightening cycle that punished leveraged traders rewarded disciplined holders. Think about it. If the Fed raises rates because money lost value, then any asset with a fixed supply becomes inherently more attractive. Gold used to fill that role. But Bitcoin, borderless, auditable, programmable, is simply more efficient. Even J.P. Morgan, once one of crypto's harshest critics, now tracks Bitcoin's performance as a liquidity gauge. Their April 2025 note stated, "Bitcoin has decoupled from speculative tech stocks and increasingly trades as a hedge against fiscal fragility." Translation? The more the Fed tinkers, the stronger Bitcoin's independence appears. There's another side to this story, though. One rooted in mathematics, not emotion. Let's talk liquidity. Global M2 money supply shrank by roughly 3% in 2023, the sharpest contraction since the 1930s. Yet Bitcoin's supply growth stayed at 0.8%. That mismatch, human money supply shrinking, algorithmic supply steady, created the perfect environment for revaluation. Analysts call it synthetic scarcity shock. When everything else deflates, the few assets that don't can reprice violently. It's the same principle that sent gold to record highs after the 1970s stagflation. Only now it's digital. And that brings us to the institutional paradox. For years, Wall Street dismissed Bitcoin as a toy for retail investors. Then, quietly, it started building on-ramps. BlackRock filed for its Bitcoin ETF. Fidelity opened crypto retirement accounts. Corporate treasuries began experimenting again. MicroStrategy, Tesla, and even mid-tier asset managers in Europe. Why? Because the Fed's policies made traditional safe assets unsafe. Treasury yields soared, but bond values collapsed. Holding dollars was profitable in the short term, suicidal in the long. Institutions realized they needed diversification, not away from risk, but away from trust. Larry Fink said it himself. Bitcoin has become a flight-to-quality instrument. When the CEO of the world's largest asset manager calls Bitcoin quality, you know the tide has turned. Now, here's the cruel irony for the Fed. Its interest rate hikes were supposed to crush demand for hard assets. Instead, they created record debt service costs for the government itself. As of this quarter, U.S. interest payments exceed $870 billion a year, more than America's entire defense budget. Every dollar raised in rates pushes the deficit higher. Every new bond issuance reminds investors that the system feeds on debt. That's not strength, that's dependency. And investors see it. Global central banks, from China to Poland, are diversifying into gold, commodities, and, quietly, digital reserves. Several sovereign wealth funds now hold Bitcoin exposure through ETFs or indirect vehicles. Because the question isn't, is Bitcoin risky anymore? It's, is the dollar eternal? Let's pause for a second. If you're listening to this and holding Bitcoin, Ethereum, or any crypto asset, you've probably already sensed the shift. And in a world where financial systems can freeze, seize, or censor, security matters more than ever. That's why today's episode is brought to you by Ledger. Ledger gives you full control of your digital wealth. Cold storage, complete privacy, and zero third-party risk. No exchange lockouts, no custodial middlemen, just your keys, your crypto, your sovereignty. You can grab yours at the official store. The link's in the description. Protect your assets before the next policy pivot begins. Now back to our story. And the part no one saw coming. When the Fed started hiking, analysts expected risk assets to die. Instead, Bitcoin evolved. It matured from a speculative play into a macro hedge. Compare performance. From the start of 2023 through November 2025, Bitcoin outperformed the S&P 500 by 200% and gold by 150%. It did this while enduring exchange collapses, regulatory crackdowns, and liquidity squeezes. Why? Because unlike fiat systems, Bitcoin doesn't depend on confidence. It creates it. Confidence in code, in math, in transparency. The Fed controls money supply by decree. Bitcoin controls it by algorithm. When humans lose faith in discretion, they gravitate toward automation. That's not rebellion, that's evolution. The more you study this cycle, the more you see a repeating pattern in monetary history. In the 70s, High inflation led to gold revaluation. In the 2000s, tech disintermediated banking. Now in the 20s, Bitcoin is merging both forces, scarcity and technology, into one financial revolution. When the Fed tightens, Bitcoin's volatility expands, but so does its long-term conviction base. Every rate hike shakes out short-term traders and replaces them with ideological holders. That's why Glassnode calls this phase the conviction epoch, and it's showing in the data. More than 75% of all Bitcoin supply hasn't moved in over a year. That's an all-time high. That means the real sellers are gone. The Fed might control interest rates, but Bitcoin now controls belief. Analysts at ARK Invest project Bitcoin could reach between 180,000 and 250,000 by late 2027 under current macro conditions. They base that not on hype, but on historical supply shock models and institutional adoption rates. Goldman Sachs' crypto research desk estimates that even if global money supply grows at half its current pace, Bitcoin would only need to capture 2% of global reserve diversification to hit those levels. 2%. That's how small the shift has to be. Meanwhile, the Fed is trapped. Cut rates too fast, and inflation resurges. Hold them too high, and debt costs spiral. Either path weakens fiat confidence further. Bitcoin, by contrast, doesn't have to do anything. It just has to exist. Every Fed meeting, every stimulus package, every trillion-dollar deficit, they all market Bitcoin better than any influencer ever could. So what does the next phase look like? Probably not explosive euphoria. At least not yet. More like slow realization. The understanding that the Fed is no longer the sole conductor of the global economy. You can already see that narrative taking shape. Emerging markets are experimenting with Bitcoin reserves. Major banks are building blockchain settlement rails. Tokenized treasuries now settle daily on Ethereum and Avalanche, blending traditional and digital finance. The system isn't collapsing, it's mutating. And through it all, Bitcoin stands as the benchmark of non-sovereign trust. That's the irony at the heart of this whole story. The Fed wanted control. Bitcoin offered freedom. And in trying to preserve control, the Fed accidentally proved why freedom matters. The next time someone tells you Bitcoin only rises when money is easy, remind them, Bitcoin rose in the tightest liquidity cycle in 50 years. It didn't rise because of the Fed's mercy. It rose because of its failure. Every era has its pivot, the moment when faith quietly shifts from one system to another. In the 20th century, it was gold to dollars. In the 21st, it might be dollars to code. And if that sounds impossible, remember, that's exactly what every empire said before its money changed forever. Drop your thoughts in the comments, hit follow, leave that 5-star rating, and as always, we will see you at the top.